All right. So, welcome back to the South Florida Mortgage Report. It's your hat dude wearing mortgage guy, Billy May, with Craig A. Garcia, president of Capital Partners Mortgage. We are the premier boutique lender in beautiful South Florida. We're so blessed to be living in South Florida, right, Craig?
It's been a gorgeous season, and it's starting to warm up a little bit. But yeah, it's great to be here.
Absolutely. Yes. Speaking of warming up, unfortunately, rates are warming up too. We had this slight dip below 6% for a little bit there, and the Freddie Mac survey came out and kind of trending upwards. It's been kind of a rough week for a variety of reasons. And is this pending or what's going on in the Middle East doesn't help us, right, Craig? And it's all
Yeah,
about oil at the end of the day. And I mean, oil has a big emphasis on everything, and it's impacting rates.
yeah. I mean, last week we were talking about how we had a worse than expected minor inflation report, and yet the bond market was very resilient. And then things changed, and now we are in a war in the Middle East. And so there's a big correlation between oil, the price of oil, and interest rates. And the reason is that everybody uses oil. And so when oil gets more expensive, that is very direct driver to the inflation. Inflation is bad for interest rates. So that's kind of what's going on. So yeah, I feel like sometimes we just can't have nice things. We're under
Yeah.
6% and now we're
Yeah, it
not.
was trending downwards. So I always tell people, listen, rates go down slow, but they go up really fast. And they've been trending downwards, got dipped below 6%, and now we're selling about 6%. And for the foreseeable future, I guess we'll see what happens with this war. But I don't know, it's looking good. But our topic today, our main topic we're going to talk about today is we're going to talk about FHA loans. And FHA loans, you can still get a rate in the fives, actually. It's a good product. And we're going to talk about some of the misnomers, some of the ups and downs, the good. And there's a lot of good stuff with FHA loans, whether if you're a buyer or if you're a realtor watching, listening to this, we're going to really get to the meat of the matter and do a deep dive into FHA. And a lot of good stuff. I guess let's jump right into FHA, Craig. If you do know or do not know, FHA only requires 3.5% down payment. You can get a gift for the down payment. Family help is allowed. FHA is really flexible with credit, and it's flexible with debt to income ratio. It's a very common phrase we use in our business. So it opens up the pool to a lot more buyers. And especially if you're a buyer, maybe what is 670, 680, maybe even a 700 credit score. When you look at FHA, 3.5% down versus conventional. Now you can get a conventional loan with only 3% down if you're a first time home buyer. But if you have a 680, 690 score, you look at FHA, 3.5% down, conventional 3% down, you might choose FHA. But we're going to talk about the pluses, the minuses, and all the good stuff, right, Craig?
Yeah. And for those who aren't familiar, so FHA stands for the Federal Housing Administration. And an FHA loan is really a loan that's provided that the government's not doing the loan. People like us, lenders do the loan, but the government is insuring the loan. And so because the lenders get this government insurance, and the insurance protects the lender, it doesn't protect the buyer, right? But that protection for the lender allows the lender to be more aggressive in certain areas. So even though you just said on a conventional loan, you could even do 3%. So you can actually do a little less down on a conventional loan, but it's much more restrictive than what you can do on an FHA loan with the extra 0.5% down. So with 3.5% down on FHA, the playing field expands a lot, expands in the way of credit. You don't have to have perfect credit to get an FHA loan. You can stretch your income more on an FHA loan than you can on a conventional loan. And it's definitely flexible when it comes to where the down payment can come from and that you can get a cosigner to help you get on the loan.
Yeah.
So Bill, what kind of credit score? And when we talk about credit, what kind of credit score can you really have?
Well, it's a good question. You can get now on a conventional loan, you need a 620 middle credit score. Now, remember, this is a credit score when a lender pulls it. Triple Mortgage Credit Report, 620 middle credit score. FHA, you could do 3.5% down with a 580 credit score. And you could actually get an FHA loan, believe it or not, with a 500 credit score, but get up at 10% down. So from 500 credit score to 79, get up at 10% down. There's a lot of other restrictions as well, some debt to income ratio restrictions and everything, but you could. So if you're a buyer that, had a serious maybe credit issue years ago, and your score is still in the, the 500s, but you're putting more than 10% down, FHA will be a good fit for you. And the pricing on that would still be very, very comparable. That'd be really, really good product. I mean, good pricing, actually. One of the other key things about FHA that a lot of people are not aware of is on FHA, you can get the sellers to contribute 6% of the sales price towards closing costs and prepaids, where compared to a conventional loan, you can only get the seller to pay 3%. In the state of Florida, 3% of the sales price won't cover all of your closing costs. 6% of the sales price will definitely cover all the closing costs. So you could probably get a little extra, maybe buy the rate down to get a better payment. That's another key factor, I think, that people like.
Super relevant in this market where there's a lot of negotiating going on, a lot of seller credits involved in transactions. And so, yeah, if you want to get all of your closing costs taken care of in the transaction, paid for by the seller, you may, depending on what you're putting down, certainly if you're putting the minimum down, FHA is going to help you.
Yeah. Oh, absolutely. I had a closing, I think just a few weeks ago, last month, and I met the buyer at the property. It was going to need a lot of work, and they bought it. And their score was, I think, right around 600. And they had the seller because the realtor knew it was going to appraise, and they got 6% seller concessions, and they were able to pay for all their closing costs and bought the rate down a little more. And very, very good payment with a good rate. I think was right around 6% or maybe slightly above. And it can be done. Like you said, Craig, it gives you more flexibility and more negotiating because you have that availability. And it's really FHA is really geared towards the people, like we said, that the more credit flexibility. That's where it really it helps people.
Yeah. So let's dive into that a little. So one of the ways that is pretty helpful on FHA is when it comes to credit. If somebody has a charge off on an FHA loan, FHA doesn't make you pay the charge off.
That's right.
So you could have some problem in your past where you had a car repossessed and you still have this balance that's out there that's due and it's been charged off. It's not a collection, but it's sitting there in your credit as a charge off. Some mortgage programs are going to make you pay that off in order to be able to qualify for that loan. FHA won't make you do that. So it's flexible. Also, if you've had something really bad happen to you where you've had a bankruptcy, if you had a Chapter 7 bankruptcy and you were discharged, a conventional loan will make you wait 4 years before you can be considered. That doesn't mean you're going to get approved, but you have to wait 4 years from the date of the bankruptcy to be able to get considered on a Chapter 7. FHA, you only have to wait how long?
2 years, right?
2 years,
Yeah.
half the time.
Yeah.
So that's much more flexible, and that's a real thing that we see, and considering the fact that somebody has to go bankruptcy, as obviously there's something bad's happened in their life, but they've been able to recover for 2 years, and they don't have to save that much to put a down payment. We've definitely helped over the years, many people in that situation, and that's a real godsend to be able to do that.
Absolutely. And only 2 years of bankruptcy. And you can reestablish credit after you have a bankruptcy, believe it or not, a lot quicker than a lot of people think, because once you file bankruptcy, everything's wiped clean. You got to start over. There's definite credit cards you can get out there. You can get secured credit cards that'll help reestablish your score rather quickly.
Yeah, and if it was a Chapter 13 bankruptcy, you really just have to be finished with it and complete it successfully, and you don't have to wait at all. So
Right.
that's pretty good.
Yeah. No, no, no. Great stuff. What about with alternative credit, Craig? I mean, we never really jumped to that, but I haven't had that issue in a long time. On FHA, are they allowed to bill alternative credit? Years ago, I remember we used to do
Yeah.
that.
Sure, if you've got somebody who doesn't have any credit, then there are lenders that will allow you to build your credit using alternative methods. In other words, hey, I don't have any credit that I've been using. I haven't borrowed any money, but I do have a history of paying my rent on time. I have a history of paying my cell phone bill on time, my car insurance on time, and I can provide 12 months of documentation for that, either a letter. There's even services now that you can get it added to a credit report, which
That's
can be
right.
helpful because it can even help you get a credit score in the process. But it is definitely possible. It doesn't mean that the door would be shut for you on something like that.
Yeah. Yeah. No, no, no. It's a great program. It helps out many, many people. All right. Another cool thing about FHA, Craig, maybe as opposed to some other programs, that people ask me, can the down payment, can it be borrowed?
Well, yes and no, right? So
Right.
you can't borrow it on a credit card,
Right.
but you can borrow it with certain other loan programs Down payment assistance programs. We have plenty that there are programs that you can get from the state that we offer. You can get programs from the county or the city. And sometimes those are grants and they don't have to be repaid. And sometimes it is a second loan.
Right.
Absolutely. You can partner that with an FHA loan. Hometown Heroes program is one example of that.
Yes.
And that's one with some income limits. We even have our Home Key program, which is an FHA loan that partners with a second mortgage that is not really through a state. It's not through any government. It's a private second that allows the person to borrow 100% really between the 96.5% on the FHA, 3.5% on the
That's
second
correct.
one.
Yeah.
And they don't have to be a first-time buyer. There's no income limit on that program. So there's a lot of different ways that people can get in without even their own 3.5% in their own money. And yeah, if they also combine that with a negotiated contract where the seller's paying closing costs, I mean, they could get it with very little to nothing. I mean, you famously closed your family not that long ago, a couple of years ago, with $14 on the closing statement. And that was it.
Right. Yeah. Then I bought a $450,000 house, I think, with like $5,000 or something, and that was an FHA loan.
Yeah.
So
Yeah.
yeah, I mean, there's lots of so yes, the answer is yes, the down payment can be borrowed, like you said. Can be borrowed from a credit card. It's not a secured, line of credit here, but there's down payment
And you,
assistance
and
programs, which we have plenty of those. So
and you can't borrow it from family either. It's really, you really can't. You can borrow it from certain approved sources,
right,
or you can get a gift from family.
you can get a
But they
gift.
don't
That's
really
right.
like you to borrow money and you can also borrow, and this applies to other loans too, but just to be clear, you could borrow against an asset that you already own. You could
That's
borrow
true.
against your car for the down
Right.
payment, and then you have to qualify for that payment. You could borrow against your current property that you own. So you could do that. You could borrow against the CD.
That's
So
right.
those in those cases you could borrow as well.
Well, it's a
Um,
pledged asset, so to speak, I guess, or 401k or whatnot. Um,
yes.
but another thing you'd mentioned too is gift funds. We say gift funds, so we have to document the gift fund on FHA. How do we document a gift from a family member for the borrower?
So usually, in fairness, for years, this was a big sticking point for FHA loans. We had to get a copy of the donor's bank statement.
Yep.
We've loosened that requirement recently to the delight of these very generous family members that have been kind enough to give their family some money to buy a house, but really don't want to be involved in as an applicant. And so now we really just have to. Usually, there's a wire involved. Maybe a canceled check is one way to do it. We definitely need to document that the funds came from the person who filled out the gift letter. So, but that's not that difficult. If you're listening to this, you're thinking about getting that. The lenders are always very, very particular about documenting this. So don't, when you're over at the barbecue at your uncle's house, don't let them hand you some cash and think that
Right.
you're going to use that to close on a house. It's not going to work that way. You're going to have to paper trail it. And
Yeah.
so your loan officer, we would walk you through how to do that. But it's not a
Eh,
challenge. It's just important to know
yep.
you just can't appear. The money can't just appear.
No,
Yeah.
it's a gift letter that we generate. It's going to have the borrower's name on it, the donor's name on it, the relationship. I think they have to put their bank name on there, maybe even account number. But like you said, we used to have to get the bank statements, which used to drive the people nuts because they tell you, oh yeah, we'll give you the money, but they don't want to give her the bank statement sometimes. So they have to document that gift. So that's a good one. Speaking of people want to help, what about co-signers or non-occupant co-borrowers? We call them. Can you have a co-signer on an FHA loan?
You can have either. And the only difference is whether or not that person, a co-borrower is usually on the title of the property, a co-signer is just co-signing them alone. They're not an owner of the property with you. So you can do that in both regards. And it's usually that's a family member. It's usually that's going to be restricted to. And it definitely can be done. We do it pretty often. And we even do it with people who don't have income themselves. So you can even have a college student and the family wants to, instead of having them rent for 4 years at a university,
Yeah.
they may decide they want to purchase a home and let their child live there. And so so the child gets on the loan with the parents. The child doesn't really have the income. They're a full-time student. Parents qualify for the loan. They can still do the 3.5% down. It can be pretty nice.
So is there a difference between a co-signer and a non-occupant co?
The co-signer technically is not on the property. and the co-borrower is somebody who's usually on the property with the main person who's.
Gotcha. And like you said, it's designed for somebody who maybe they don't qualify. They're I had, matter of fact, I had one last year. It was like he was in grad school. He just getting ready to grad. He doesn't have a job yet. His parents want to help him buy a home down here. So he was on it and they were on it and they used their income and their credit. So good stuff. Good stuff. And mostly because it'll, like you said, it'll help with the debt to income ratios. But that could be a family member too. So remember, it's got to be a sibling, mom, a dad, aunt, uncle, etc.
Yep.
Pretty much that. With FHA, so as we said, it's really designed for people, first-time home buyers. I remember you don't have to be a first-time home buyer with FHA.
You do not.
On a conventional Fannie Mae loan, you've not to do 3% down. You have not owned a home in the past 3 years. FHA doesn't matter.
Correct.
I've had people call me up and I can't do it. I owned a home last year. No, FHA doesn't matter. It's great for credit rebuilding too. Great for higher debt to income ratio. Now that's a key one, right, Craig? Because on FHA loan, you may qualify for a lot more home than you think.
Absolutely. And so for the same borrower, you may find that you may qualify for a conventional loan or an FHA loan, but the amount of home that you can buy may be a lot more with the FHA than the conventional. Conventional is more restrictive when it comes to the debt to income ratio, where FHA is much more consistently expansive on how far you can stretch your debt to income ratio. You might qualify to buy on a single family house. You might be able to spend another $80,000, $100,000 going FHA than you could going conventional.
That's huge.
So, it can be.
Yeah, that's huge.
Yes.
And because of the flexibility, and another reason too is their interest rates are usually slightly lower than conventional, so that helps out.
And we didn't really talk about this, but not only can the rate be better than a conventional loan, the more middling to lower your credit score is, conventional is going to penalize you on the rate, and it's going to penalize you on the mortgage insurance rate that you're paying, where FHA does not penalize you at all on the mortgage insurance rate that you're paying. And mortgage insurance, if we just glossed over that, is the insurance that protects the lender for doing the loan. So if you're doing a conventional loan, then that is more expensive. The less you're putting down and the worse your credit score is, you can get very expensive. FHA is a flat number regardless of your credit score. And that can make a big difference.
Oh, it makes a huge difference, especially with 3% down on conventional. If you're not, I think it'd be like pretty much 720 or above is really when below that, FHA is better. Let's talk about the mortgage insurance, because like you said, the mortgage insurance factor in FHA is the same. Now, the downfall is an FHA loan, and this is the big difference. This is the negative. Yep. The downfall is that now on a conventional loan, let's say you put 3% down, you have your mortgage insurance, you can get that removed eventually at some point, whether you get to 80% loan to value, or maybe you call the loan servicer a few years later after you've done some upgrades, have the home appraised for at least, you have 80%, you might be able to get it removed. But with FHA, it's on there for life. That's the one challenge. FHA has what's called this upfront mortgage insurance. It's a mortgage insurance premium that it's rolled into the loan. It's 1.75% of the loan. It's rolled into the loan. So they're not technically coming out of pocket with it, but it does increase the loan balance.
That's right. If you just looked at the costs for obtaining an FHA loan versus a conventional loan at the same loan amount, FHA is going to be more expensive looking, even though you're not paying some of that cost out of your pocket. So that's that mortgage insurance that we talked about is what is giving all that flexibility to the program. There's a cost, and the government uses those funds that they collect to keep the program going and to make homeownership attainable for people through this flexible program. And so that's the cost of getting the FHA loan. That would be the downside. With all the upside that it has, that would be the downside.
Yeah. That is the one downside. So FHA, who is it perfect for? First-time home buyers, people with credit rebuilding, higher debt to income ratios. They can qualify for more, and like you said, maybe $80,000, $90,000 more, which in South Florida is very helpful if you live in expensive areas. FHA is not a bad loan. It's probably the most flexible loan in America.
If you're not a veteran.
Not a veteran, that's right.
I would say it definitely is.
So, right. You're not a veteran, but it's a great product. And definitely consider a FHA loan for your purchase. Good stuff. So let's talk about FHA loans and what are some of the myths that cost home buyers and let's kind of go in because there's this perception, Craig, from a lot of realtors, usually the old time realtors, that FHA, they get scared, they get nervous, they don't want to deal with FHA, especially if they're a listing agent, old, they've been around for a long time. Yeah, years ago, 20 years ago, FHA was a different product animal, so to speak. We don't have a lot of those issues today. But what were some of the issues back then, or why do you think agents are scared about FHA loans?
Yeah, it's funny because we've definitely heard it many times. Agents feel like an FHA appraisal is going to kill their deal.
Yes.
And this is probably more myth than reality. So there's some reasons for this. I mean, back in the day, FHA was definitely much more stringent on the property. So anytime, and this is not now, but before, anytime you were doing an FHA loan, if you had any part of the roof that was a flat roof, like a lot of people have a porch in the back and that's a flat roof.
Well, that's
Anytime you
right.
had a flat roof, you had to get a roof inspection done, and it had to be by a licensed roofer. They had to say the roof was had at least a 3-year life expectancy. That was definitely always there. You usually needed a termite report, a clear
Yep.
termite report on an FHA loan on a regular basis. And there was just this perception that you couldn't get through anything with the property on an FHA loan, but you could on a conventional loan. So you don't really need those rules anymore.
Yep.
You may need a termite report if the appraiser goes out there and sees wood rot and sees evidence of termites or something, they can still call for that. But as a rule, you don't have to have a clear termite report to get an FHA.
Yeah, they definitely used to be more picky about that years ago. Wood rot, when we're in South Florida, the wood rot was very common. I remember 20 years ago that were picky, but that those days are gone. Really, I don't really see much of a difference between FHA and appraisal and conventional appraisal, but there are some differences, right?
Yeah. One other thing is that I've definitely heard people think that, this property has a roof leak, an active roof leak. So you can't get an FHA loan, but you could get a conventional loan.
No, you can't.
Reality is
Right.
that the conventional loan is going to care about that roof leak as well. So most of the time, whatever would be a concern on an FHA appraisal, most of the time it's also going to be a concern on a conventional appraisal, where that's not exactly, and usually the words that comes up with FHA and in general, you'll hear safe, sound, and
Safety.
secure.
Yeah.
That's what an FHA appraiser is out there to determine with the property. So you could have a situation where on a conventional loan, this would be an example of something that would come up on FHA that wouldn't come up on conventional. And they're not they're kind of nichey things. So you might have a window that doesn't open, for example. It's kind of a broken window. That would affect the safety and soundness and security of the property from an FHA standpoint, but a conventional appraisal is probably not a big deal.
Yeah.
You could have a door that doesn't work exactly properly that might not come up be a big deal on a conventional appraisal, that they might say, hey, this is an issue that FHA would like to get resolved.
Right.
Yeah, if there's really a safety issue, it's probably going to come up either kind of a loan.
Uh-huh.
We just had somebody came to us at a realtor. It wasn't the deal we were involved with, but it was and I think it was a conventional deal where the appraiser and the underwriter called for a tile to get repaired because it was a tripping safety hazard. And when you look at the picture of it that they showed me, you could see the tile was broken and it was like chipped up and there was a big sharp edge sticking out.
Really?
And so,
Okay.
and it seems very minor and the seller did an inconvenience for them to fix it. But unfortunately, you get into a liability situation with the lender. Lender doesn't want to have any kind of risk for that. And they don't want the buyer to get hurt.
Yeah.
But they're looking at liability concerns with something like that. So that can come up.
Also, the FHA or VA appraiser, I think they do peek their head in the attic, right?
That is one difference between an FHA and a conventional deal. If there's an attic, FHA appraiser is required to do a head and shoulders inspection of the attic, which basically means they're going to stick their head up there and look around.
Right.
So what could that really mean? Well, if you had, that could be one of these things where if you walk through a property and you look around, you don't see anything wrong with the property. You don't see anything wrong with the roof. Sometimes if you look up in the attic, you might see some stains from where a roof leak maybe had been prior repaired. That might cause you to need to get a roof inspection or something of that nature. So, but that is one little thing that happens. And so every once in a while, you'll find a transaction where the appraiser has to come back out. They started doing the appraisal as a conventional appraisal. The deal got flipped to FHA, and they have to go back out and just in the head and shoulders inspection of the attic.
Oh yeah, I had one of those about like a year and a half ago. We had to flip it to an FHA, and unbeknownst to me, that they had pressure cleaned the house. The appraiser had to go back out there, and there was chipped paint everywhere, and the house was built like in 1968. And so since it was before that 1978, the lead disclosure, the appraiser's like, I went back to reinspect the property. There's paint chips all over the yard. and then vacuum it up and they had to paint the house again too. Because before 1978, there was this thing about, people used paint, lead-based paint to paint the house, and the FHA saying, listen, if they chip all this paint off, that could be lead paint now all over the ground. So that they had to vacuum it all up and go back again.
Could be a health concern. That is one of those real niche things that could come up. Yeah, flaking paint on an older house. So,
but realtors, sometimes they get scared about this stuff. And I did have one last year that my buyer was putting an offer on a townhome that did not have roof access. Okay, had a flat roof, there's no attic. And the listing agent called me up and they said, I can't take this offer because I'm afraid FHA, they're going to want to cut a hole in the ceiling and look up there. They're not going to do that. If there's no access to the roof, I mean, don't worry about it. They're not going to do it. But she actually said that to me. So that was one of the misperceptions again.
That is amazing. Yeah.
No. But two funny stuff. So yes, appraisers, they don't go in the attic, like you said. They peep their head up there, make sure there's no active or past leaks, whatever like that. They're just looking for some obvious issues. Okay, it's not a full home inspection. I've had people ask me, well, FHA is going to do this full home inspection. I'm like, no. This is not a full home inspection. They're just like an appraiser. Yeah. So, yeah, you're right. Just really interesting stuff you hear with FHA sometimes. So, but one of the other things too on listing agents I've heard, and they asked me about that, is that, hey, if I take this listing, let's say the buyer buys the home, FHA, and the appraisal is done, the appraisal comes in low, and the buyer backs out, doesn't that appraisal stick with the property for X amount of time?
So there is truth to this. Now, and here's where it would impact things is if the next buyer comes and they're also going FHA. So there's a case number. Every time an FHA loan gets started, we have to generate a case number, and that case number is for the borrower and the property. And then property, that case number will stick with that property for 6 months. So any new lender that comes in and tries to do an FHA loan on a particular property, and if it's a purchase, they'll run a search in FHA for the property, and it'll come up and they'll see that there's an existing case number. And if there was an existing appraisal that's on that, and that appraisal is been done within the past, 4 months, then the lender is going to probably use that appraisal on the new transaction. They're going to use the new appraisal on that new transaction, unless they determine that they don't like that appraisal or there's some valid reason that they have for getting a new appraisal. But the standard approach is that'll have to use that appraisal with that new FHA buyer. If the next buyer is conventional, doesn't matter at all.
Yeah.
So there's that works both ways. There are times where that's very convenient for the new buyer because they already know what it appraised for, and it turns out that was perfectly fine for the seller, but maybe the buyer had a qualification problem, so the buyer didn't complete the sale for whatever reason.
Good point.
And now they come in and they already know this property already appraised. And now this FHA buyer will be able to use that appraisal. They usually do reimburse the prior buyer.
That's right.
To be able to use that appraisal. Right. So it's not really a cost savings, but they would know upfront that it is done. The flip side is if the seller wasn't agreeing to that appraisal value, and now a new buyer comes, they're also FHA, it's going to be a certain amount of time is going to have to pass. And it's probably getting closer to 5 months or so before a new appraisal is going to be justified by a new lender.
Gotcha. You said, speaking of flips, that's a concern with FHA as opposed to conventional, right? So what is a flip? I mean, a flip is defined as, somebody buying a home, usually an investor, they bought it for cheap. They're going to rehab it and they want to turn around and resell it with the rehab for a higher price to make a profit, obviously. But FHA, that can be an issue. How is that an issue, Craig?
So there's a very specific rule with FHA that you don't find in other loan programs typically. But this one says that the seller has to be on title for 90 days before they execute a contract to sell it to a buyer who's going FHA. So really, they're not supposed to have signed that contract until the first day that they've been the owner. And so this can definitely be something that doesn't come up. It should come up early on in the process. I would say if you were a realtor listening to this, you want to have your spidey senses and your radars going off anytime you're working with an FHA buyer. You walk into a vacant property that has been totally redone. That should be something to just kind of keep in mind. How long has that person owned the property? If they just bought it 2 months ago, put a bunch of money into the property, now they're selling it for a profit, there has to be that. And if you go under a contract on the 65th day and that loan gets to underwriting on an FHA loan, it's going to get turned down.
Yeah.
And then on the 91st day, it's going to have to you have to go to contract on a fresh contract and then get the appraisal done then. And so you definitely want to keep that in mind. Sometimes and sometimes that rule kicks in on situations like I just described, where you have an investor who came in, bought a beat up property and fixed it up and now it's selling it. Could also just be other situations too. And if you have a quick claim deed or something like that from one person to another, that can sometimes come up. The only time that the property can change hands and it's really not flip is if it was somebody's maybe company and then they owned the company 100% and then they deeded it to themselves. And so it was just a transfer amongst the same person or a company that person owns.
Right.
Or if a lender had foreclosed on it and now the lender's the seller and it was a real foreclosure situation, that's not going to be considered a flip in that case either. But that could come up. But that's really important. You could actually be too early to buy that property as an FHA buyer.
Yeah, that's right. The loan officer, the realtor really is go online, make sure the property, it's been at least 90 days, do an FHA, make sure you won't have that flip issues. Another word you mentioned that he says about vacant. What happens if property is vacant? Can there certain inspections have to be done or something?
One thing that comes up on an FHA loan bill is if there's certain areas, you're going to run into this all the time. If the property happens to be on a septic system and not on city sewer, and if that property is sitting there vacant, and they're going FHA, the buyer's going FHA, they're going to need to get a septic inspection on that property. They assume if the property is occupied by somebody that they don't have a sewage problem, that everything is okay, and you don't need that particular inspection. So, but that's when that would come up. So that comes up sometimes.
Yeah. Yeah, we don't see a lot of that down here in South Florida. I think most of South Florida is on city water, but you get to the Palm Beach County, maybe Southern Dade or something, that does happen periodically. But a lot of stuff. Boy, we've really delved into a lot of information here on FHA. Is there anything else you want to add about FHA that maybe our buyers or realtors should be aware of?
I think it's good for buyers and agents to know that there is, in some agents' minds that are representing sellers, there is a bias against FHA.
Yeah.
There's this beliefs that we talked about before that, hey, the FHAs could be harder on the property. And then there's also the belief, which is partly reality, partly perception. Whereas the belief is, hey, maybe this buyer can't get a conventional loan. There maybe is something wrong with this buyer. Maybe the buyer's not as strong as they could be versus other offers. So it's just something to be aware of. I think there was certainly a time that it was a lot harder to get a contract accepted if you were going FHA. I don't think that's not the market that we're in today. So I think everybody's much more accepting of that, and because it's used pretty frequently, I would say for buyers, but it could be out there sometimes.
Yeah. Yeah, I'd be interested to see like what percentage of our loans are FHA. But I do see, I do see, like you said, most agents will accept it only once in a while. Usually it's an um, you know, older agents been around for a long time, and they have those preconceived notions. Oh, why do they have to go FHAs? There's something wrong with them. They don't have a lot of money. So it's yeah, that's still that misnomer compared to, like you said, you got the business, I got the business 20 something years ago. It was much harder back then to do an FHA loan. So it's quite much different market we're in today. So
I remember my first probably year in the business, I get an FHA loan, and this is my first year, but I got a list of conditions, and it was probably 80 conditions.
Right.
One of them was, this was back when not only did you have to do all this stuff with the roof and the flat roof and the roof inspection, but we had to get, it was we had to make sure that the survey had the distance mapped off, from the well to the septic. And there was a lot of stuff on there that it was pretty daunting. I remember looking at it going, you'd have to be kidding me.
Right.
But we did close that loan.
Yeah.
But it used to be much more challenging. But it's a widely used product. People use it every day.
Yeah.
And it's a fantastic tool. And what people might look at it and think, well, that's a negative that somebody had to take that. It's also, you've got the most flexible program, so it gives you a lot of options when you're trying to get deals done. And that's really, really important in this market.
And another thing too, I forgot about it. You and I both forgot about it. We forgot FHA loans are assumable.
That's true. That's true. Yeah, you might even see a property advertised. Hey, assume this loan.
Yeah.
If you see that, it means that whoever the buyer is could apply if they're qualified and assume that mortgage. That can be very attractive. Certainly is attractive when the people who bought and did FHA a few years ago are now trying to sell their property and they have a 3-point-something% mortgage on it.
No, there's tons of FHA loans that are out there that were written in the whole decade from 2010 to 2022. There's tons of FHA loans out there that are sub 4%.
So, yep. So it's important to realize this is a very nice thing to have as a feature because of the loan that you're taking. So once you're eventually the seller, if you're one of those buyers and you're thinking and you're trying to get an FHA loan now, and you find some property that they're looking, they have a 3% FHA loan, and you're currently thinking I'm going FHA, the challenge is going to be they probably you can't borrow what they're asking for the property. You can only get assume the loan that they already have. So if they're selling you a house for $500,000, but they only have a $270,000 FHA loan on it right now, and you're trying to assume that means you need to come up with $225,000 in cash.
Or find a lender like us that can provide you a second mortgage that gets you to 95% financing.
That's true. That's true. We do have a second mortgage company that will bridge that gap.
Yeah. Yeah.
But so that's an interesting point.
We got to cover all the bases here, So
yeah, let's talk about it all.
Yeah. Well, good stuff, Craig. I mean, I think we got a lot of information here for our listeners worldwide, and just great stuff. And if you're an agent, do not discount FHA. It's a great product. It's a flexible product. It's going to give you more buyers and get you the most bang for the buck if you're a listing agent. And it's a great product if you're a buyer's agent and if you're a buyer. So that's awesome. So, all right, Craig, any big plans for the weekend? You all set?
No big plans. No big plans. Now, next week, I think we're going to have a break from the South Florida Mortgage Report for a week. So
we got to enjoy our beautiful weather down here.
Yes.
Yeah. So
all right, sir.
All right, sir. Well, hats off to you. And as always, we will see you
at the closing table.
All right. Take care.